All right. Today is Sunday, July 25th. This is a recap for the week that was and an outlook for the week to come. And what a week it was. A monstrous roller coaster ride. Opening down on Monday to the tune of about 1,000 points down on the Dow. Only to stage a reversal, a 180, not just recouping all of the losses from Monday, but building on and closing in the green for the week. The SPY, the Qs, all closing in the green with gains. Sizable gains, and this is yet another sign for the excess and the mania in the markets today. Investors and traders see a dip, they stampede right away, buying stocks with both hands, with the assumption that every dip is worthy of buying, and so far they have been proven correct. However, this is a bad setup for perhaps one of the most important weeks of earnings in recent history, specifically for big cap technology names. Now, when the market moves impulsively higher, trading at all-time highs, and we have some of these stocks gaining double-digit gains ahead of earnings releases, this sets up the stage for a massive disappointment to come if these earnings don't live up to the expectations of these insane, crazy moves higher in these stocks. We're talking about double-digit gains ahead of earnings. These earnings better come out pristine, otherwise we're setting the stage for a massive disappointment in the market here. It's a phenomenon known as buy the rumor, sell the news. Pump the market ahead of earnings and then cash in those profits, sell the news when these earnings reports come out, regardless of beats or misses on the top and bottom lines. Companies can produce good earnings, but not pristine, not perfect, not matching the market's expectations, and that sets up the stage for a move to the downside, perhaps a massive one. Even though companies beat the top and the bottom line in earnings, a lot of new investors and traders are surprised. Why is the stock trading down 5, 6, 7% when the company just beat earnings and revenue expectations? Well, revenue beats and earnings beats, that means nothing at all. It's a bunch of douchebag analysts who stated a random number as quote-unquote expectations. And then the number comes out, the actual number, beating or disappointing the threshold from analysts. That means nothing at all. What matters is the expectations set by the market, not by the analysts. And the expectations set by the market happen to reside where the market is trading right now. And it is trading at all-time highs. Anyhow, in focus tonight, we have the Chinese crackdown against Chinese companies for now, namely Didi and Chinese education companies, some of which were down to the tune of about 70% on Friday alone. And then we're going to talk about the housing mania, the housing bubble. I got updates for you and personal experience anecdotes. And then, of course, we will talk about earnings. Earnings remain at center stage in the market right now.
我命令全军各级要强化练兵备战鲜明导向。
In recent weeks, we have seen elevated levels of tensions and nationalism coming out of China. And when you listen to the speeches of Chairman Xi, one cannot help but to notice the conflict between Chinese ambitions. On one hand, they want Chinese firms to be global firms and competing with large corporations from the United States and the European Union. On the other hand, these are private businesses, and if they thrive on the global stage, they will be burdened and beholden to whatever their biggest market. Furthermore, these thriving Chinese companies are creating powerful billionaires who can challenge the CCP. And we saw what happened with Jack Ma, for example. One criticism, one soft criticism of the CCP, and the man is gone. China is struggling between maintaining its communist roots and being pragmatist with implementing certain capitalistic policies and allowing Chinese firms to thrive on the global stage. Yet recently, the CCP is starting to get worried about the magnitude of growth and power some of these Chinese firms have. And now they are using the approach of decoupling. They want Chinese firms to be less dependent on foreign markets and more dependent on the Chinese market. In the last couple of weeks, Didi listed an IPO in the US markets, raising a few $billions. Immediately, the Chinese Communist Party decided to punish Didi, cracking down on the company, and we're seeing massive losses in the stock since the IPO, taking down other Chinese stocks with it. And on Friday, we got the news that the CCP is cracking down on online Chinese education companies, and we saw names, the likes of Tal Education, New Oriental, down to the tune of about 70% in a single day. Some of these stocks, for example, Tal Education, is down 90% or more year to date, which brings up the possibility of delisting. And if that happens, we will see massive losses in these stocks, and a lot of investors, US-based investors, will lose a lot of money in these Chinese stocks. The $1 million question, or billion, or trillion, it all depends on your dreams and ambitions. But regardless, the big question is, when will the time come for the Chinese Communist Party to start cracking down on US firms? We're talking about American companies highly dependent on the Chinese market, namely Apple, Nike, Starbucks, and Tesla. If Chairman Xi wants decoupling for Chinese firms to be less dependent on foreign markets, weakening their global competitive advantage and weakening their competitive prospects with US firms, one cannot help but to ask the question, when? When will the Chinese Communist Party crack down on American companies too? They're not going to let Apple make billions and billions of dollars out of the Chinese market and get away with it when we in the United States punish Chinese firms like Huawei, for example. They're not going to allow Tesla to make billions and billions and billions of dollars out of China when the United States bans Chinese firms like NIO from selling cars in the United States. It is just a matter of time before the CCP cracks down on US-based firms. And the tensions are rising, and the expectations are, do your own homework. Look at the financial results and financial statements for Apple, Nike, Starbucks, and Tesla. Without China, these companies are nothing. The number one growth market for these American firms is the Chinese market. Once again, it is just a matter of time before the CCP cracks down, and it will be ugly for these American companies. Next, let's talk about the housing mania, the real estate boom, and perhaps the bust to come. We continue to hear more stories, more anecdotal evidence of people lining up blocks away to view a property on sale or a new rental property that just hit the market. We continue to hear more evidence that people are offering hundreds of thousands of dollars above the asking price to secure the property and win the bidding war. We're seeing bidding wars, not just in home sales, but now we're seeing these bidding wars migrating to the rental market. For example, over the weekend, I did an experiment where I looked at open houses for both houses for sale or houses for rent in the city of San Diego, where I live. The property for sale had a massive line of people waiting outside, and I talked to the property owner. He is overwhelmed. He did not expect this much demand because guess what? It was one of the few houses available for sale in the entire city, and he had so far that day, the first day of open house, he had over 179 offers in just a few hours of showing the property. The other property was a rental property. Small house, tiny, very tiny, listing for about $2,500 a month. Massive line outside. And again, the landlord is overwhelmed. And he said, I hate this market, folks, because he had at least 6 families inside the house, and he was giving them the tour and the rules to apply. As he's speaking, more people are walking in the door, and we're not talking 1 family or 2 families. We're talking over 5, 6, 7 families lining up, and once they enter the house and they see other families also applying for the house, and the landlord saying that I had over 100 applications today alone. Oh, and by the way, the application fee is $40. So now the landlord made about $4,000 from applications alone, minimum. And as people walk in and see the scene, they turn back and they walk away. We're seeing people saying, you know what, too many applicants, there is no way we're going to qualify for this rental house. And they're moving away. The demand is extremely high. The supply is nowhere to be found. And people are taking reckless decisions, buying properties they cannot really afford. Signing new leases, they cannot really afford. And when you look at the facts, the San Diego region is perhaps the hottest housing market in the entire country. Folks, stop moving here. No vacancy. We got no vacancy. There is nothing here. Oh, the beach, you say? You know, I've been living here for years. I don't even go to the beach anymore. It's polluted, toxic waste. It's absolutely disgusting. Watch the 60 Minutes documentary about Tijuana, Mexico, dumping toxic waste to the tune of over millions of gallons of toxic waste into U.S. waterways, into the beaches of San Diego. Toxic waste. And of course, our weak leaders, they cannot even do anything about it because, God forbid, they appear less woke as they turn up the heat against Tijuana. Moral of the story is no vacancy, folks, in San Diego. And the problem is some of you are moving here without even securing a job. Wow, what a bunch of geniuses. You know what will happen if the stock market crashes? If, God forbid, the Federal Reserve is forced to cut the cocaine operation due to inflation, what will happen is the stocks of all of these companies will crash down. And when we see a market crash, confidence gets shaken out. And now all of these companies, and it has a ripple effect, by the way, it doesn't have to be public companies. It's a domino effect that will trickle down from publicly listed companies all the way down to small businesses, including private businesses. They will start laying off employees. Now think about it. Even if you got a job and you moved in here, now you're signing up a lease for a shitty house, a tiny, not even a studio, a tiny little house, a hut for $2,500 a month. What will happen if you lose your job? God forbid 3 to 4 months from now. Well, you're stuck with the lease, $2,500 a month minimum. And by the way, whoever wins that listing is going to offer to pay above the asking price. They're going to offer the landlord $3,000 a month to win that particular listing. What will happen if you lose your job and now you're stuck with $3,000 in rent every single month? You're not going to call your landlord and say, you know what, the market crashed and we're moving back to deflation. Please lower my rent. It's not going to happen. Either you pay the rent or you're going to get evicted. Similarly, what will happen to all of these people moving around the country, buying houses, offering hundreds of thousands of dollars above the asking price to buy a property? And some of these people moving to Boise, Idaho, for example, but they're still working in California. And they say, oh, my employer is generous enough to allow me to work from Zoom. What will happen if you lose that job? And now everybody in Boise, Idaho is competing on the 5 jobs left in that particular city. How are you going to pay the mortgage? See, when Jerome Powell says that this housing mania, this housing bubble is different from the previous one because we don't have reckless lending and subprime mortgages and all of that, what he's missing is the amount of risk that individual people are taking, going beyond their means, stampeding to pay above the asking price for a home or above the sticker price for a used car, being emboldened by their stock portfolio gains and by the job that they have right now. They have a source of income. But when the market crashes, their stock portfolios will go down and perhaps their employers will cut jobs as we move from hyperinflation to perhaps stagflation or even a recession. What will happen to all of these people? What will happen to all of these people as a result of reckless risk-taking? This is what the Federal Reserve is not paying attention to. They continue to say, oh, people have high savings rate. They paid their credit card debts. Their wages are going higher. They're doing fine. So they're not taking unnecessary risk to buy houses, or buy used cars. But what they're not factoring is how dependent this so-called economic recovery on the elevated stock market levels, which are not sustainable, by the way. And that leads us to earnings. Let's talk about earnings, and I apologize I did not do a slide, so I'm using this screenshot from dickhead Jim Cramer. On Monday, we have Tesla, and once again, we're looking at the competition, the war in the EV market. How is that impacting Tesla? In addition, what about the Chinese market? Are they continuing to grow in that particular market, or is the growth slowing down? And by the way, folks, this will be perhaps the most important tech earnings season in recent history. And the reason is, seldom when we see all of big cap technology stocks reporting in the same week. This week we have Tesla. On Tuesday we have Apple. Alphabet, Microsoft, and AMD. Wednesday, we have Boeing, Bristol-Myers, McDonald's, Facebook, and Ford. Thursday, we have MasterCard, Amazon, Twilio. Friday, we have Exxon, Chevron, Caterpillar. But all eyes are on Apple, Google, Microsoft, Facebook, Amazon, the big cap technology stocks, all reporting in 1 week. And the stakes could not be any higher than this. These companies have to ace, that's the key word, ace their earnings beyond expectations. Well, we know that, at least in the case of Apple, they're highly dependent on the Chinese market. You look at a stock like Alphabet, for example, Google. It is vertical. It is moving in a vertical line. And this is perhaps the number one stock that is under threat, because when you look at Apple or even Amazon, they've been consolidating within range since last year. They moved a little higher recently, but Alphabet specifically moved in an insane fashion, which makes it the riskiest stock to hold this earnings season. Before we move on to charts, I want to share with you important information, macroeconomics information we received on Friday. And pay attention here, please, because there is a massive debate between, we're heading into inflation, hyperinflation, stagflation, and another camp of analysts and market observers saying that we are heading into deflation and perhaps a recession. Let's look at the facts. On Friday, we get the IHS Market Composite PMI for the services and manufacturing sectors in the United States. And the number was down. This is the headline number, meaning the economic activities are going down. But let's read the specifics and the particulars, and you'll realize that this is not deflation. This is not transitory. This is, if anything, stagflation. Pay attention here. Let's read the services PMI first, and then we'll move on to manufacturing. The services PMI says the seasonally adjusted IHS Market Flash U.S. Services PMI Business Activities Index registered 59.8 in July, down from 64.6 in June. This indicated that the rate of expansion slowed once again from May's record high. But, and this is the big but, remained substantial overall. Where a loss of growth momentum was noted, firms linked this to labor shortages and difficulties acquiring stock. Ta-da! Contributing to the softer expansion of business activity was a slower upturn in new business across the services sector in July. The pace of growth was the least marked for 5 months. As some firms noted customer hesitancy, pay attention, amid significant hikes in selling prices. Ta-da! Similarly, the rate of increase in new export orders eased. Service providers indicated a robust uptick in cost burdens in July. Ta-da! Amid hikes in supplier prices and a greater need to hire additional workers. At the same time, the pace of charge, are you sure it is charge or change? Anyhow, the pace of charge inflation remained substantial as firms sought to pass on higher costs to clients. Once again, ta-da! Although firms recorded a solid increase in employment, the level of outstanding business rose further in July as service providers struggled to keep up with incoming new business. Amid labor shortages and pressure on capacity, firms noted the lowest degree of optimism since February. Does this look like deflation or stagflation? Prices are too high to the point where it's slowing down economic activities. What about the manufacturing PMI? July data signaled the fresh serious record employment in operating conditions, as highlighted by the IHS Market Flash U.S. Manufacturing Purchasing Managers Index PMI, posting 63.1 in July, up from 62.1 in June. So while the services PMI was down, contributing to the composite to read down, the manufacturing PMI was actually higher, 63.1 versus 62.1. Supporting overall growth was a quicker rise in new orders across the manufacturing sector as new and existing customers ramped up their spending. Firms also saw a stronger uptick in foreign client demand. In turn, the pace of output expansion accelerated to one of the fastest in 7 years. Production rose at a slightly quicker pace despite further reports of material shortages. Ta-da! Material shortages. In fact, the rate of backlog accumulation quickened to the second fastest on record since May 2007, despite the pace of job creation accelerating to the sharpest for 3 months. Meanwhile, lead times lengthened markedly and to the second greatest extent on record. Once again, folks. Meanwhile, lead times lengthened markedly and to the second greatest extent on record. But I know, where is inflation, huh? Supply chain disruption was reflected once again in efforts to increase purchasing activity and build safety stocks. Stronger demand for inputs globally and scarcity of materials led to the fastest rise in cost burdens on record. Ta-da! Subsequently, the rate of charge inflation accelerated to a fresh serious high. So once again, the CNBCs of the world, they share the headline number, and the experts that they say, oh, you see, inflation is transitory, is cooling down, but the devil is always in the details. You and I are paying attention. The morons on TV are not. Anyhow, moving on to cover some charts because we have important developments here. But remember this, we gotta move the shift from technicals to fundamentals. We've been moving that shift from technicals to fundamentals for about a couple of weeks now. First, the inflation data, CPI, PPI, and now we have corporate earnings. So the technicals will matter less as earnings take center stage. But regardless, we have to look at the charts, starting with the SPY 30 minutes chart. And by the way, look at this chart. Is this a real chart or is this a meme? I mean, sometimes in this market, you look at charts, not just stock charts, but economic indicators and the likes, and you ask yourself a question, is this a joke? Is this a meme or is this real? This is one of these charts. And of course, shame on me. I was expecting a consolidation around 430 and 435 before we move higher after earnings. Not before earnings, but this is the meme market. Shame on me for forgetting that. This is one of the craziest market reversals and bounces in history. Down 3%, up 4% by the end of the week. In 1 week, we're seeing this kind of volatility. This is what Jerome Powell calls market functioning. Now, on Friday, the SPY opening another gap, moving higher to all-time highs, surpassing the double top resistance, former all-time highs of 438. Folks, we are now trading at 440. Can you believe it? And the formation we have from a candlestick pattern, mind the gap, the candlestick formation is indicating a bull flag formation, meaning more highs to come. But I'm not liking any of this, so I'm not giving the bull flag, and I'm taking the risk, taking the heat, and giving this a thumbs down. It is so far defying the gravity of technicals, the gravity of charts, normal charting behavior. Look at where the RSI is trading. Look at the MACD indicator continues to hover at elevated levels. And this is from a 30 minutes chart, meaning that from a 30 minutes perspective, the move is overextended. But beside the technicals, there is another reason why I'm giving this the thumbs down. Who bought the dip? Who was responsible for buying the dip and pushing it higher? We knew ahead of time on Monday, and I told you, the market will bounce higher. The move was over-exaggerated to the downside. We will bounce. But I did not expect to bounce to this magnitude. Not just recovering all of the losses, but going all the way to all-time highs. Never heard of before. But who was buying the dip? This is the most important question. The answer is you and I, retail traders and investors. It's actually not just you and I. It is new blood, new flow of retail traders and investors who've been watching the stock market, waiting and waiting and waiting for a dip to buy. They saw at least 2 dips before, 2 sizable gap downs. Both of them were proven to be bear traps, so they assumed, correctly for now, that this will be yet another bear trap and they should buy. And we saw new flow of retail investors buying the market at these elevated levels. You and I are already in the market. We might have bought the dip via call options, but you and I, we buy, we sell as a trade, in, out, hello, goodbye, quick profits, and we're done. The majority of stock positions that you and I have, I'm assuming, of course, I don't know what your positioning is, but I haven't bought stocks since March. I'm already in, I'm not buying anything right now. And guess who's not buying anything right now? The snakes on TV, the pumpers, who come out every day, yeah, buy the dip, we're gonna go higher, Tom Lee and the likes. They're already all in. They're just pumping, and they want you and I to buy the dips and assume the risk at a market trading at all-time highs. And now we have new blood joining the market. And this is exactly what will happen, by the way, in the housing market too. The moment prices go down, you will see new blood all of a sudden stampeding once again to buy the dip in the housing market. So long as this mania fueled by the Fed's cocaine is still intact, every dip in every single market will be bought aggressively, be it stocks, bonds, commodities, or even housing. But the problem here with this dip buying in the SPY and the Qs in the market in general is the fact that we're heading into earnings. Earnings could disappoint, and therefore I'm giving the thumbs down. Not only we have elevated technicals, exaggerated bounce to the upside, but the expectations are too high now, and if earnings don't come out pristine, highly impressive, beyond expectations, the risk is to the downside. The pumpers will take profits, leaving new blood to get slaughtered. And here is the daily chart for the continuous contract for the SPY. Notice that the bounce happened on low volume. The volume elevates on the downside, not the upside. And this is yet another indicator that we're seeing some options speculation from the retail side in this bounce, which make the bounce less sustainable than legitimate buying of stocks. The momentum indicators strengthened significantly. They're trading positive now, both the RSI and the MACD. We don't have a crossing and confirmation yet, but the repair is evident. The chart is trading above all-time highs, and the assumption here is until and unless you see a reversal signal, you're not going to short this one. If anything, you might want to ride it higher, but be careful here of being the Johnny-come-lately. You might get a day on Monday, perhaps a day and a half, but earnings will hit, and the market will move based on earnings. Buying is risky here, and so is shorting, because you have no clue what earnings are going to look like. Rational investors like you and I, we're going to grab a big bag of popcorn and watch the show. After earnings are out, Apple, Microsoft, Google, Facebook, Amazon, the big ones, we're going to have a clear picture here of what's going on with the economy and specifically with these massive technology firms. Until further clarity, making decisions right now is impulsive and goes against disciplined investing and trading. What about the Qs? 30 minutes chart. Once again, I'm highlighting the instances where the MACD indicator was supposed to cross to the downside, only to bounce higher and bounce again and bounce again. It's not going to be able to bounce all the time. It's going to have to cross, creating red impressions in the histogram, indicating that the momentum in this bounce is fading away, and we will see a pullback. The resiliency is stunning because they continue to buy these big cap technology names, defying the technicals. My expectations were that we're going to consolidate around 363 until we get more clarity from earnings. But now the market already did the move ahead of earnings, risking that we're going to face the phenomena of buy the rumor, sell the news. Be honest with me here. Even if you are a perma bull, would you buy this chart right now at this setting, looking at the MACD indicator, looking at the RSI, looking at the magnitude of the bounce already? Would you buy the Qs right now, knowing that we're heading into earnings? Not likely. Even if you are a perma bull, the likelihood is that you're going to start to de-risk as we head into earnings, perhaps booking some profits, maybe buying some put options, selling upside calls, covered calls, all of these strategies to mitigate risk ahead of earnings. I wait till we look at the chart of the VIX. But for now, we're looking at the daily chart for the continuous contract on the NASDAQ. Again, surpassing 15,000, the all-time highs. Way beyond expectations, at least my expectations. The momentum indicators, significant repair in the MACD and the RSI indicator, even though the RSI is reading below the last move higher. It is a massive bounce rebound higher, but it is not recovering the same strength as the prior move. Likewise, the volume is down, indicating that perhaps we have some elements of options trading here in this bounce. And once again, the guy you're listening to right now is not making any move whatsoever. I'm not chasing this move. We might get a day or two, a day and a half, before we get big cap technology stocks earnings, and things will change. So it's kind of too late to ride this wave. You should have spotted the bounce from the beginning, just like we did in this channel. You played it via call options, you made your VIG, in, out, hello, goodbye. For now, we're watching in anticipation of what will happen after the big cap technology stocks earnings. If you have some of these stocks in your portfolio, once again consider de-risking via hedging strategies. Buying puts, selling upside calls, taking profits, all of these strategies will work. If you are a trader and you want to bet one way or the other, your appetite for risk is a little higher. Let's say you want to bet that big cap technology names are going to pop higher after earnings. Perhaps the most disciplined strategy is to sell puts prior to earnings. That way, if the stock market pops higher, specifically these big cap technology stocks, well, you're going to capture the credit from those puts. But if they go down and you're still optimistic and you're still positive on these names, you will get the chance to own them at a discount. If you are bearish, if you're a trader and you're bearish on this chart on the NASDAQ, you want to bet to the downside. My recommended strategy is buy calendar puts. That way, you take advantage of the elevated premiums on earnings week, but you also buy some time for the trade to work. For example, let's say you buy a put option trade on Apple and the stock actually pops a little higher after earnings. If you bought the put options expiring this upcoming Friday, you're going to lose money 100%. But if you open a calendar put trade, yes, the leg that you sold will expire worthless, and that's good. You capture the entire credit. But the put you bought perhaps a few weeks from now, expiration date, will be reduced in value, but you still have a lot of time for the trade to work. You can manage the trade. You can exit at a smaller loss. You can reduce your entry cost if the NASDAQ or these big cap technology stocks pull down later. Calendar trades give you a lot of flexibility here, so use them when you can. What about the IWM 30 minutes chart? See, I'm not so bullish on the Qs and the SPY, but if I have to bet on an index to go higher, I will bet on the IWM because the air came out of this one already. We saw a massive correction down from the highs. It is trading in some indicators at oversold levels. And now we have, from a 30 minutes perspective, a double bottom, double confirmation at 218, that perhaps 218 is a strong support, at least for now. So using risk versus reward, would you rather buy the SPY, the Qs, or the IWM this upcoming week? If I had to take a shot, I would choose the IWM because the sell-off already happened in this one, and it's taking its time to recover. This is the healthy way. Mind you, the IWM is, ironically speaking, is dependent on meme stocks, the likes of AMC and GameStop. And we will look at the chart of AMC by the end of this video. And perhaps there is some hints of positivity for AMC. Anyhow, this is the daily chart for the RUT, the Russell 2000. Once again, bouncing from the line in the sand, the support line, the critical line to keep. It's a massive bounce. It was anticipated, at least in this channel. The problem is the chart is still trading below the bull to bear advantage line at around 2,264, meaning that the bears still have the advantage. But once again, you look at these indicators, they're oversold. They're starting to become more positive. So will the bulls turn the table against the bears and push this chart a little higher, perhaps above the bull to bear advantage line? We will see. What about the Dixie, the US dollar? Once again, this is perhaps the most important chart to watch in the market right now. It is highly extended. We've been anticipating a top for weeks now. It got a top. It has to top at 93. You cannot go above 93 because going above 93 will open the door for another massive pop higher in the US dollar, and this will have ramifications, big ones, on metals, commodities, and even stocks. But the behavior of the chart, the resiliency of the chart, even against elevated technicals, by consolidating around 93, just underneath 93, going back and forth, grinding its way to break above that level. I don't know if the pop will happen above that level or not. For now, I am trusting the elevated technicals and saying perhaps the US dollar needs to pull down to 92 at least before creating any rally higher. But remember, it is the battle between technicals and fundamentals. We talked about the technicals. What fundamental factors do we have this upcoming week? The FOMC meeting. If they decide to hint at tapering or talk about tapering or talk about talking about tapering, then that will impact the US dollar accordingly. Tapering means US dollar goes higher. This is the assumption because it lessens the amount of cocaine in the market. But if the Fed decides to go with the narrative, well, we have delta uncertainty and therefore we need to push tapering down the line, and that will mean that the cocaine operation will continue and we will see more flow into the market, and that should push the US dollar down. And therefore, we're seeing gold consolidating here, not doing anything at all, going back and forth, not sure what to do. Gold is waiting on the move and the guide from the US dollar. The momentum indicators remain weak for gold. They have strengthened since the bottom and the rebound around 1760, which happens to be the Fibonacci retracement level. But I'm not sure if I'm going to make a call here. If I'm betting that the US dollar will go down, then the natural bet is that gold will pop higher. And this is perhaps a bull flag consolidation of the bottom, and we will see gold popping higher. But what if the Fed says, you know what, we're looking at the data and we are in consensus to taper now? Then gold will go down as the Dixie goes higher. Now understand that Jerome Powell will likely not, this is his personal preference, by the way. He doesn't want tapering to happen before his term expires next year. Jerome wants the job. Jerome wants a renewal of his term as Fed chairman. Remember that Jerome Powell is Republican, Biden is Democrat. Will Biden renew Jerome Powell as the Fed chairman? We will see. Wall Street certainly loves Powell. He's been generous to them. He's been very good to them. He's been the best thing that ever happened to them, and they want him to stay in the job. Biden, I'm not sure. Perhaps he wants to play a woke card by appointing Brain Dead as the new Fed chairman because she's a woman, or perhaps Boystick because he's black. Mind you, all of these people are in one club. All of them agreed in increasing this inflation and hurting the poor and middle class, causing this housing mania, making the rich richer. Brain Dead and Boystick, both of them agreed on these policies. So we're just shuffling faces here, folks. What about yields? What's going on here? Holding at 1.28 by the end of the week, closing slightly below that level, but not significantly, so it is still holding at 1.28 basis points as support. Yields better move higher this upcoming week. The pop of 128 basis points should happen this upcoming week. If it doesn't, if we continue to consolidate here, then the risk is to the downside for yields to create lower lows in this series of a descending trend line. Folks, as we see with ascending trend lines, meaning bullish trend lines, you cannot diverge from the trend line for too long. Big divergences mean pullbacks are imminent. Likewise, in a descending trend line, the divergence from the trend line cannot hold on for too long. You're going to have to pop back and revisit the trend line. In this case, it's a bearish trend line for yields. This is the assumption, but I'm sharing economic information with you every day. And I shared the market PMI numbers in the intro of this video. They're indicating that economic activities are slowing down, meaning growth is slowing down, but inflation continues to rise higher. And this is the dilemma for yields. What do you do with this information? Heading into stagflation, do you pop yields higher? Because yields going higher is an indicator for economic growth. But if inflation is hurting the prospects of economic growth, then what do you do? Because you still have inflation. Yields should pop higher in anticipation of a reversal in the monetary policy. This is the dilemma in the bond market right now. Speaking of, here is the TLT weekly chart, closing slightly below 149, not a big deal. Is this a weekly reversal candle? Not really, because it did not erase prior gains from prior weeks. It did not close below last week's candle. So far, you cannot say that this is a reversal candle in the TLT. It is a pullback, and now it is awaiting confirmation. And by the way, we saw gains in the volume for the TLT, elevating higher. And if you study the 30, 45, or even 1 hour charts, you'll see that the majority of elevated volume came to the upside, meaning buying and short covering. So for now, there is still an appetite to bid against yields and for bond prices to go higher. What about the VIX 4 hours chart? While the SPY and the Qs were making all-time highs, everybody was celebrating. We're out of the woods, the correction is over. On Monday, the dip buyers showed up, and here we go again. The VIX did not go down significantly. The VIX was down about 2%, holding the consolidation range between 17 and 17.5, which we talked about in prior videos. What does that say? Underneath the market, as it reaches all-time highs, there are perhaps institutional investors buying some protection here, buying volatility and SPY puts prior to earnings. My expectations are the market saw a massive rebound. Yes, we went from 25 all the way down to 17, but if the VIX is going to make higher highs and curl higher from these levels, then we're going to see another pop higher in the VIX and perhaps a reversal in the SPY. Moving on to Apple, and we are looking at a weekly chart for a change. We're not looking at the 30 minutes chart because there's nothing significant there. The chart is still consolidating between the range of 140, 145, and 150. But when we look at the weekly chart, the momentum indicators are strengthening. Apple moved about 20% to the upside in a few weeks. We have a series of higher highs and higher lows. At some point, this chart has to pull down and create a higher low. It created a higher high. Now it has to create a higher low. This will be, by the way, healthy behavior, bullish trend in the name. But a crazy move impulsively higher to the upside is not expected at this time because the chart is already created higher highs. The expectations are for creating a higher low. This is how normal chart behavior works. You don't just go to the moon without stops and maintaining trends. I know in this meme market it happens, but this is the biggest stock in the world, folks. A valuation of over $2.5 trillion. It is extremely hard to move this stock as a meme, regardless of the billions and billions of dollars in call options buying, which we saw this past week. Stampeding and buying a significant quantity, and all of these expired worthless, even though the stock moved significantly higher. What about Tesla, the souffle? We're watching the 30 minutes chart still. We talked about the series of lower highs, and we were asking the question, at least in the previous video, is the souffle about to create a higher low or a lower low? If it creates a higher low, then the bulls will gain advantage, and the assumption is the chart will blast above 657 next week, meaning this upcoming week. Well, guess what? The chart created lower lows and a lower high, and now the bears have a significant advantage. But remember, we are still trading within range. 629 support, 679 as resistance, and the bull to bear advantage line is 657. We have earnings on Monday. How do you trade this one? The assumption is that premiums will be elevated. If you have the souffle in your portfolio, and let's say that you are holding profits, not holding the bag, how do you protect your shares? The easiest way is you sell an upside call. Let's say you have to go a little higher, by the way. You go to the 700, for example, and you use some of that credit to buy the 629 or perhaps 600 puts, depending on when you started buying the souffle in your portfolio. So you adjust your numbers accordingly, but the trade remains the same. You sell an upside call, aka a covered call, so you have to have 100 shares or more of the souffle. You cannot sell upside calls, folks, if you don't have a minimum of 100 shares of an underlying stock. The last thing you want to do in the options world is to sell a naked call. It can be a recipe for disaster and financial destruction. Let's say you don't have 100 shares of the souffle. What do you do to protect your shares? You buy a put. Simple one with the expiration date of this upcoming Friday, just in case if the stock flushes down for whatever reason, the competition from Ford and other players, the rise in raw material costs, any surprise from China, you protect yourself by buying some puts. Now, what if you are a neutral trader and you want to take an opportunity here and bet to the downside that Tesla will disappoint and we will see the 629 support line broken? Do it via calendar puts. Simple strategy. But in this case, if you're going to use calendar puts, you want to go a little lower. You want to go to 600 perhaps, because if you sell the 629, it could happen this week and now you're going to have to buy it back at a higher price and your profit prospects go down. So you want to open the 600 puts calendar. So you sell the 600 puts expiration date this upcoming week, and then you buy the 600 puts with the expiration date of, say, next week or perhaps August. It doesn't matter. It is called calendar trade because you're opening two different expiration dates for the same strike price. Moving on to tulips, BTC. What's going on here? 4 hours chart. We had the massive bear flag formation playing out to the downside, breaking 30,000, and then we saw the rescue operation by Jack Dorsey, Reverend Elon, and Mama Kathy, going back all the way to the descending line, the resistance line. And the question was, will the tulip faithful have the energy, the money, and the will to buy the dip here and push it higher? And so far, they did, breaking above the descending line, meaning that the laser beams are gaining significant advantage here. But the next test will be 35,750. One step at a time here, laser beams. What about ETH, Ethereum? Another tulip, which I happen to hold right now, because I bought it once Elon pumped it, and the expectations are, at least this is my exit strategy, to go all the way to 2,500, even 2,400. I'll be happy with a small gain. And by small, we mean double-digit gains because these are tulips after all. The momentum indicators are still strengthening. We have a double bottom formation. The setup is opening the door for buyers in this tulip to push it higher at a minimum to 2,500. Will buyers show up? I'm not sure. I showed up. Anybody else with me? We'll see. What about AMC, apes? What's going on here? 1 hour chart. The support of 32 is still holding. We had the double bottom formation. We had the shorties covering, but the apes did not follow up like the laser beams did, and we saw AMC trading down. The good news is that the chart is creating a higher low off the double bottom. It is not confirmed yet as a low. You gotta trade a little higher on Monday for AMC to confirm that this is a higher low. But if it is, are we starting a new trend of higher lows? This is what the apes have to do. The AMC bears still have the advantage because significant damages have been done, and the apes, psychologically speaking, did not show up. So the bears still hold the advantage from a technical and a psychology perspective. Anyhow, moving on to the conclusion of this video, we're going to look at the economic calendar. What do we have on the agenda this upcoming week? On Monday, we have new home sales, and this is critically important. Forget about existing home sales. We can have a surge of supply from existing home sales as people decide to sell their homes and list their homes. You know what? Perhaps the mania is coming to an end. Let's list some homes and dump while the market is still hot. But the real test is new home sales. Are we seeing more supply in the market? And how is the demand receiving that new supply? This will have implications on lumber prices, by the way. Tuesday, July 27th, we have durable goods. And once again, the Case Chiller Home Index, a critically important one. The last reading was the highest reading on record since the index started, and reaching levels, by the way, not seen since the days prior of the housing bubble, the housing bust in 2007-2008. And then we have the Consumer Confidence Index. Then on July 28th, Wednesday, we have the FOMC meeting, the conference from Jerome Powell. This will be highly critical, and as I said a couple of weeks ago, that we are shifting from technicals back to fundamentals. Fundamentals of earnings, and now fundamentals of macroeconomics data. What the Fed's response is going to be. Thursday, July 29th. We have, per usual, the jobless claims, the weekly jobless claims. We also have the first estimate for the GDP, and then we have the pending home sales index. It's an important week for the housing market, by the way. Friday, the finale, we have personal income, consumer spending, core inflation, the Chicago PMI, and most importantly, the final reading for the University of Michigan Consumer Sentiment Index. Consumer sentiment went down in the last reading. We need a confirmation now. Why would consumer sentiment go down? Because consumers are worried about inflation. You want to go rent a house, an apartment, and there are 100 people ahead of you. You're paying more for groceries, gas, bills. Everything is going higher, and therefore this is impacting consumer confidence negatively. Lastly, before I sign off, for the trader who asked me about Roku's chart, I promise you I did not forget about you, but I will create a different video, a separate video in the morning, charts to watch. We haven't done any of these recently, and I have at least 15 to 20 tickers, individual stocks, individual charts that we're going to look at. And Roku's chart will be in that video. Anyhow, folks, that's all for tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.